JPMorgan just dropped their latest earnings report, and on the surface, wow, the numbers looked absolutely huge. But the market's reaction? Well, that told a completely different story. So, what really happened behind that big headline beat? Okay, let's break it all down. Here's what we're going to cover. First, we'll look at those impressive headline numbers. Then, we'll dig into why the stock actually faded after the earnings call. We'll find the real story hiding in the Q&A, lay out our final rating for the stock, and then wrap it all up with a potential trade idea. All right, so at first glance, this was a textbook JPMorgan quarter. I mean, it looks strong, clean, and pretty impressive right across the board. Let's start with the bottom line, which was a really solid beat. They reported earnings per share of $5.07, which has crushed Wall Street's consensus estimate of around $4.85. That's a pretty significant beat, about 5%.
And you know, it wasn't just earnings. Revenue came in hot at over $46 billion, also beating expectations. And maybe most importantly, they raised their full-year guidance for net interest income. That's a bank's core profit engine to nearly $96 billion. So you've got a beat on earnings, a beat on revenue, and a raise on guidance. It really doesn't get much better than that, right?
Now, what's really interesting is where all this strength came from. Their corporate and investment bank was just firing on all cylinders. Markets revenue was up a massive 25% year over year, driven by these huge gains in both equities and fixed income. Even investment banking fees, which have been a bit slower to recover lately, popped up 16%. It's just a perfect illustration of how powerful their diversified business model really is.
Okay, so we've established they had a clean beat and they raised guidance. Logically, you'd think the stock should have rallied pretty hard. But that's not what happened. Not at all.
After that earnings call wrapped up, the stock was actually down almost 2%. It was a classic sell-the-news reaction, and it left a lot of folks just scratching their heads.
And this quote just highlights that disconnect perfectly. I mean, even professional money managers were out there calling it a classic strong quarter. But the stock price was telling a completely different, much more worried story. So this is the million-dollar question, right? What was said on that earnings call that completely overshadowed all the great results? What could have possibly spooked investors enough to start hitting the sell button?
Well, the answer wasn't in the big splashy press release. Nope. It was buried in the management commentary during the question and answer session. And this is where the whole forward-looking narrative took a very sharp turn.
You can almost picture it as two competing stories fighting for control in real time. The bull case was super simple. Just look at the numbers. They're fantastic. But the bear case? Well, the bears were listening for clues about the future, and they latched onto two big concerns: expenses and credit quality. So the first red flag came up around expenses. Management basically told analysts that their 2026 expense estimates looked a little bit low. Now, that's a subtle warning, but what it implies is that expense growth could run around 4% next year, thanks to things like labor inflation and higher medical costs. And of course, higher expenses mean lower profits.
The second worry was all about credit. Now, overall, credit is still super healthy, but the company did take a pretty notable $170 million charge-off tied to a single specialty auto lender. Management also warned that charge-off rates have been historically low, almost unsustainably so, and that some normalization, which is really just a fancy way of saying more losses, is probably coming.
And then, CEO Jamie Dimon delivered the one line that just crystallized the entire market's fear. When an analyst asked him about that specific charge-off, he said, "When you see one cockroach, there are probably more. Everyone should be forewarned of this one." That single comment just raised the ghost of hidden risks in their loan book. And honestly, it was all the bears needed to hear.
So let's process all of this. You've got a company delivering amazing results right now, but the people running the show are planting these little seeds of caution for tomorrow. So how does that translate into our view on the stock?
Okay, looking ahead, we actually expect another strong quarter for Q4. But the market's going to look right past those numbers and focus entirely on the official 2026 guidance for expenses and credit. Because of that uncertainty, we see the stock is likely being range-bound. You know, the strong fundamentals create a floor, but these worries about the future create a ceiling. And this balance risk-reward is what leads us to our final call. So, we are initiating coverage with a market perform rating. What does that mean? It means we expect the stock to perform pretty much in line with the broader market, say the S&P 500. We just think it'll be tough for the stock to significantly outperform until there's more clarity on those big 2026 questions. Now, for our last section, let's have a little fun and explore how this market perform view could actually translate into a potential trade idea. So, think about it.
If you agree that the stock has a solid floor under it, but probably a limited ceiling in the near term, how do you position for that? You don't really want to be short the stock, but you also don't expect it to just rocket higher.
Well, one way to express this view is with a covered call strategy. For investors who already own the stock, this involves selling call options against that position. The whole goal is to collect that option premium as extra income, all based on the idea that the stock is unlikely to surge past that option's strike price before it expires. It's essentially a way to get paid while you wait, capitalizing on the view that the stock might just trade sideways for a while.
And of course, we always have to end with this. Remember that this has been a breakdown for informational purposes only. This is not financial advice.